When it comes to making smart financial decisions, one of the most eye-opening exercises is to compare how the same amount of money performs in different financial vehicles over time. In this case, we're looking at what happens when you invest $1,000 into three different options: stocks, whole life insurance, and term life insurance combined with investing. At first glance, these options may seem similar because they all involve putting money toward financial security or growth. However, when you dig deeper into how each one works, the differences become striking. The real question is, which one actually creates the most value over time, and which one comes out as the winner? Today, we will talk about $1,000 invested stocks versus whole life versus term life. Winner revealed. So, before we start, make sure to hit the like button and subscribe to my channel. Let's begin with stocks, which are widely recognized as one of the most powerful tools for building wealth. When you invest $1,000 in the stock market, you are buying ownership in companies. Over time, as those companies grow and generate profits, the value of your investment has the potential to increase. Historically, the stock market has delivered average annual returns of around 7% to 10% over long periods. If we assume a conservative 8% annual return, that $1,000 could grow significantly over time thanks to the power of compounding. After 10 years, it could be worth over $2,100. After 20 years, it could grow to around $4,600. After 30 years, it could reach over $10,000. The longer you stay invested, the more powerful this growth becomes. This is why stocks are often considered the best option for long-term wealth creation. Now let's look at whole life insurance. If you invest $1,000 into a whole life policy, the outcome is very different. Whole life insurance is designed to provide both a death benefit and a cash value component. However, not all of your $1,000 goes directly into growing your cash value. A significant portion is used to cover insurance costs, administrative fees, and commissions. Because of this structure, the growth of your cash value is much slower compared to stocks. In many cases, early returns are very low, and it may take years before your policy builds meaningful value. Even over the long term, whole life policies typically generate returns in the range of 3% to 5% annually. This means that after 10 years, your $1,000 might grow to around $1,300 to $1,600, depending on the policy. After 20 or 30 years, it will continue to grow steadily, but still lag behind stock market performance. However, whole life insurance does offer some benefits that stocks do not. One of the most important is stability. Your cash value is not subject to market fluctuations, which means you won't experience losses due to market downturns. This can be reassuring for individuals who prefer guaranteed outcomes and lower risk. Additionally, whole life insurance offers tax advantages. The cash value grows on a tax-deferred basis, and policy loans can often be accessed without triggering taxes under certain conditions. The death benefit is typically paid out tax-free to beneficiaries, making it a useful tool for estate planning and wealth transfer. Now let's consider term life insurance. If you invest $1,000 into term life insurance alone, there is no growth at all. Term life insurance is purely a protection product. It provides a death benefit for a specific period, but it does not build any cash value. If the term expires, the coverage ends, and there is no return on your investment. This might seem like a disadvantage, but it's important to understand the purpose of term life insurance. It is designed to protect your family financially, not to grow your money. So when we compare term life insurance alone to stocks or whole life, it's not really an investment comparison. It's a protection comparison. However, many financial experts recommend combining term life insurance with investing. In this approach, you might spend a small portion of your money on term insurance and invest the remaining amount in stocks. This allows you to get the best of both worlds: affordable protection and high-growth investments. Now let's compare all three options side by side. If you invest $1,000 in stocks, you have the potential for significant growth due to compounding and higher returns. If you invest $1,000 in whole life insurance, your money grows slowly but with guarantees and stability. If you spend $1,000 on term life insurance, you receive protection but no investment growth. The key difference comes down to purpose and efficiency. Stocks are designed for growth and have a proven track record of building wealth over time. Whole life insurance is designed for protection and conservative growth, but it is less efficient when it comes to maximizing returns. Term life insurance is designed purely for protection and does not contribute to wealth building on its own. Another important factor to consider is opportunity cost. Every dollar that is allocated to whole life insurance is a dollar that is not invested in potentially higher return assets like stocks. Over long periods, this difference can lead to a significant gap in total wealth. This is one of the main reasons why many financial experts recommend prioritizing investments over expensive insurance products. Liquidity is another major difference. Stocks are highly liquid. You can sell them and access your money relatively easily. Whole life insurance is less liquid, as accessing the cash value often involves loans and additional considerations. Term life insurance has no liquidity in terms of cash value since it does not build any. Risk tolerance also plays a role in this comparison. Stocks come with market risk, meaning their value can fluctuate. However, over long periods, they have historically trended upward. Whole life insurance eliminates market risk but also limits growth potential. Term life insurance eliminates investment risk entirely because it is not an investment product. Behavior is another factor that can influence outcomes. Some people struggle to stay disciplined with investing in the stock market. They may panic during downturns or fail to invest consistently. Whole life insurance can enforce discipline through fixed premiums, but at the cost of lower returns. Investing requires discipline, but it offers significantly greater long-term rewards. So, who wins the $1,000 comparison? In most cases, stocks come out on top when it comes to wealth creation. Their higher returns, compounding power, and flexibility make them the most effective tool for growing money over time. Whole life insurance comes in second, offering stability and guarantees but at a lower growth rate. Term life insurance ranks last in terms of investment growth, but it serves a crucial role in providing financial protection. However, the real answer is not about choosing a single winner. Instead, it's about understanding how each option fits into your financial strategy. Stocks are for growth, whole life insurance is for stability and planning, and term life insurance is for protection. When used correctly, they can complement each other rather than compete. If you invest $1,000 in stocks, you are giving yourself the best chance for long-term wealth creation. If you put that same $1,000 into whole life insurance, you gain stability but sacrifice growth. If you spend it on term life insurance, you gain protection but no investment return. The winner depends on your goals, but for most people focused on building wealth, stocks come out ahead. The smartest strategy is not just choosing one option, but understanding how to use each one effectively within a well-balanced financial plan. Ultimately, the extended lesson from this $1,000 comparison is about momentum. Financial success isn't driven by a single decision. It's driven by repeated actions over time. When those actions are aligned with higher growth opportunities like stocks, the results can be transformative. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.